It is 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching the China Show. I'm David Ingles. Let's count you down to the open of markets in Greater China and get to your top stories today. As you can see, the bullish momentum across these equity markets taking hold as we wind down 2025. Stocks on the up across the Asia Pacific, while a gauge of global shares is set for its best year since 2019 after hitting a fresh closing record. We're looking in on the yen firming as the finance minister Satsuki Katayama tells Bloomberg exclusively that Japan has a free hand to act against currency speculation. And China Vanke averting a default after winning creditors' support to extend a bond repayment grace period. Good morning. Welcome to the show. Hope you're all well. Equity markets are still up, and I don't mean that with any negative connotation. So you do the count. It's 4 days in the global benchmark. That's 2 on the Asian benchmark. The reason I caveat that so early in the show is, as you can see, the yen is moving. Well, the Nikkei is moving the opposite way of most of the benchmarks out there right now, and a lot of that might have to do with a stronger currency, which we'll get to in a moment there. S&P futures up ever so slightly. Taiwan coming online, 0.5%. We do have, of course, coming today export orders, and of course that is in some ways really a good proxy for AI demand. Also on Taiwan, Citi just out upgrading Taiwan, downgrading China to neutral. We'll talk more about that call out of Citi, that out in the last few minutes or so in a moment. Flip the page, please. We talked about the yen. I promise you we'll talk about the yen. Dollar yen, euro yen, 2.10 on your screens. As you can see, we're firming on both. I would imagine we're firming against all major peers right now, following, of course, what we had and the commentary coming through, some very strong comments coming through out of the finance minister. More on that in a moment. Commodities very much in focus on Monday, still in focus today. Get this, 50 record closes on gold this year. Not to even mention gold's underperformed where you are with silver, with at about $70. Let's call it. We're now nearing 150% on the silver ladder in 2025. We're about just over $50 away from that 12,000 milestone as it pertains to copper. And of course, we're looking at things like Jiangxi Copper, the copper contract in Shanghai, on the back of that rally separately in the metal. In fact, just on that very note, let's have a look at copper. What were you doing there? There we go. Thank you so much. 0.25% to the upside. Futures are flat, slightly to the upside. And of course, dollar China, we're still waiting on 7. We are very close to 7. We could be a good 1 or 2 days away from that point in time. Hence, the fix will be very much in focus this hour. Weaker than expected fix yesterday, or on the weaker side of things. Let me just caveat that. But that did, of course, still lead to some gains there on the back of some dollar weakness. Speaking of currencies, let's talk about Japan and the finance minister and the comments there coming through. The strongest warning yet to currency speculators, telling Bloomberg that officials have a free hand to take action. Satsuki Katayama spoke exclusively to us in Tokyo.
Foreign exchange markets don't move only on interest rates or rate differentials. Especially toward the end of the year, around Christmas, trading tends to get thin, and many factors can drive the yen's moves. But the yen's sharp, very short-term movement right as the BOJ governor began his press conference last Friday, that was clearly not in line with fundamentals, but rather speculative. Against such moves, we have made clear that we will take bold action, as stated in the Japan-U.S. finance minister's joint statement.
Now that the Bank of Japan has moved to raise interest rates, the next focus is clearly on whether the government will step in with foreign exchange intervention. How do you see it?
We have an agreement with the United States that allows us to intervene whenever the yen makes an excessive move. That means we have a free hand.
In the past, a finance official has called a 10 yen move in a little more than a month excessive. So what kind of time frame and magnitude would you consider a sharp or disorderly move? Is there any benchmark you use to assess that?
I can't say definitively whether there's a benchmark or not. I worked closely with currency chiefs during my 20 years at the finance ministry, and I've stayed in close touch with many of those who came after I left. Each situation is different, so it would be wrong to expect the same pattern every time.
Trading tends to thin out around the year-end and New Year period. Is it fair to say that the authorities are fully prepared to respond if...
We're always ready to act. That goes without saying.
When it comes to a question of a certain degree of fiscal discipline, there are various ways to interpret that. For example, how much the government relies on bond issuance or how much JGBs it'll issue. Could you share a bit more on how you're thinking about these points?
I can't give you specific numbers, but even after the supplementary budget was passed, we made it clear that the total amount of government bond issuance, which, after all, is what puts pressure on the market, did not increase. At this time, we're talking about the initial budget for fiscal year 2026. We're confident that it won't be something that places an undue burden on the market either.
There are concerns in the market that Japan's fiscal position may be deteriorating. What message would you like to send in response to those concerns?
By switching to active fiscal policy, we knew before we started that in the first fiscal year, some of the finance numbers would deteriorate. But that isn't the problem. We've spent 10, 20, even 30 years in a situation where economic growth barely picked up no matter what we did. There's no point in just doing the same things as before. We need to make a decisive shift, to concentrate resources and boost our growth potential. I believe we'll see a strong pickup in investment next year. And if you look at projected tax revenues for next year and the year after, I think what looks like fiscal deterioration now will prove to be only temporary.
And that was the Japanese Finance Minister Satsuki Katayama speaking exclusively with our colleague Takashi Omikawa there in Tokyo, really on arguably, I would say, the biggest market story in the last, let's call it 18 hours or so, a massive swing down in dollar yen. We talked about euro yen. It brings to mind, and when you look at the price, I'm going to ask my producers to bring up the first board we showed with Asia Pacific ex Japan and then the Nikkei. It just goes to show a stronger currency and the pull that might have across equity markets. And how do we think about that as a risk to an equity market like Japan that's done exceptionally well at 200% since the bottom back in 2020. As you can see, we're flat on the Nikkei. We're up slightly on Asia ex-Japan, 0.3%. Ken Wong is with us here on set, Asia-Pacific, Asian Equity Portfolio Specialist at Eastspring Investments. Good morning, sir. Nice to see you.
Morning.
Some folks have told us that a stronger yen or a rally in the yen is somewhat of a risk that people are sleeping on when you look at equity markets. Do you subscribe to that? How do you look at the currency?
Yeah, I think overall, I think a lot of investors, especially the old school ones, are always concerned that when you do have a strong yen, potentially that does, sort of negate potentially some of the gains that you might see within the equity markets. But for us, ultimately, it's more about, sort of the bottom line, especially when we're seeing a lot of improvements over the past few years. When we're looking at Japan as a whole, we look at the improvements in overall corporate governance. We see specifically how overall return on equity has improved. Overall, when you look at market valuations against maybe some of the other developed markets like the U.S., it is still more attractive. So I think investors are seeing sort of the benefits as to investing in Japan. And because of that, that's why we've seen these strong rallies within the Japanese markets over the past few years, David.
Yeah, let me borrow the concept you used there. Some of the old school players looking at the market, right? So the reason I bring that up is when you look at the market like Japan, it's behaving more like an AI play, right? I'm not sure what the weighting there of the AI representation in Japan and is, as we look at bubble risks in AI, is that an issue in Japan more than the yen? The fact that you have a bigger representation now within the chip space.
I think we're calling more of an AI fatigue as opposed to a bubble. But then when you look at overall AI exposure, Japan is roughly around 35 to 40% of its market cap. So it is fairly big, similar to where we were seeing in regards to China. It's also very similar. Bigger ones is going to be Korea as well as Taiwan, which will have bigger exposure towards AI. So if there is a bit of a pullback in regards to, let's say, overall AI capex, or if specifically earnings trajectory around the whole AI ecosystem does start to deter, then of course there will be some risk. But overall, when we're looking at 2026, when we're talking to companies and when we're asking around their overall capex spend around AI-related technology, it's still there. So overall, even though we have seen a bit of a pullback, more recently around sort of some of the fatigueness around AI, we think that 2026 is still going to be fairly robust because overall companies are still spending quite a bit of capex around AI.
It's the delta, though, in the change in the capex, right? If you go from 110 billion to about 90 billion, still a big number, but people are going to go, all right, they're stopping spending now. Are you not concerned over that?
Not at the moment, but it is something definitely to continue to watch out for. Specifically, in terms of where companies are going to be providing guidance. We're at the end of the year, and then over the next few months, when companies report their full year earnings results, a lot of these questions will be asked. What are their views around AI, and where are we going to go from there?
The final one or two questions on Japan here. The economic policy of the new prime minister, and of course we just heard about the commentary around the finance from the finance ministry there. Is everything out? Is everything clear from a market's perspective? Do we have a good understanding now of what the policy still pursues and how that affects the market?
No, I think there's still going to be a lot more. We definitely still need to see more in terms of what the government will be doing in 2026 to specifically see where the yen is going to continue to head. More importantly, also where the BOJ is going to continue to head going forward as well. Because ultimately, I think it's going to be important to see kind of overall inflation levels, overall economic levels, wage levels. Are we going to continue to see specifically, stronger than expected growth? And of course, it's also going to be very important to see, kind of how all the geopolitical tensions potentially could have an impact in terms of the overall Japanese economy in 2026 as well.
Yeah, that's right. That's a good problem to have, not geopolitics, but stronger growth, higher inflation. But speaking of the latter point, China-Japan tensions, how is that going to play out in the earnings story, in Japan specifically?
Yeah, it's going to be, I think, a very important thing to see in 2026, to see specifically whether or not this is going to continue to play out. Because we did see this about a little bit over a decade ago. Remember where there's been a lot of embargoes within China in terms of, not even eating in Japanese restaurants or even Japanese-related restaurants, not buying Japanese cars. Remember that embargo?
The whole Rising Sun embargo.
Exactly, right? So in that particular sense, I think, it's going to be a wait-and-see approach to see kind of where things go, in the next few months to see whether or not that will have an impact. But certainly, if, let's say that it's not just necessarily travel-related right now, which is, I think, that initial part. But if there is going to be certain restrictions on, let's say, Japanese imports from, sort of going into, or Japanese exports going into China, then, of course, that will have an impact. But I think over the next couple of months, it's going to be very well worth watching to see kind of where things at. And again, if it does impact more than tourism, then we're going to have to kind of see how that's going to have an overall impact on Japanese economy.
Yeah, unfortunately, a lot of people are in Japan these days, so maybe we can get some anecdotal evidence. Ken Wong will be rejoining us in a couple of minutes. He's with Eastspring Investments. We're counting down to the open of trade. Hong Kong, Shanghai, and in Shenzhen, 0.3% on the overall Asian benchmark. Ex-Japan futures coming up bottom of your screens. The fix is coming through in about 2 minutes or so. Estimates there. Opening bell 16 minutes away or so. This is the China Show. Good morning. Right, welcome back. Just in time, well, about 24 seconds late, but that is just to say, just about in time for the fix. There we go, bottom of the screen, 705.23. It's clearly on the weaker side of estimates. It's really the delta from the previous day, and when you compare that to Friday. Market is somewhat adjusting on the weaker side of things, but you take a step back, it wasn't too long ago, maybe just over a week or so. We were at 707, 703, 706, right? So 703 is on the stronger side of things. That is also to say the fix is one thing we're tracking today. In the onshore market, specifically, the Chinex has been on a tear. So we're looking at that. We'll get you a chart in a moment there, which shows you actually how much it's actually outperformed the Hang Seng Tech Index. CSI 300, Shanghai Comp testing 50-day moving averages. We talked about the copper rally, so we had the likes of Jiangxi Copper in focus, the yuan strength. We talked about that. Hang Seng Vol, which is something we flagged yesterday, 4.5-year low on that. Volumes have also been on the thinner side. I guess it doesn't help that we are about a day and a half to Christmas. Vanke averting a default, and of course Cathay Pacific, I believe, was a filing late yesterday after the close, certainly, if I'm not mistaken, the second consecutive year of a profit. So we'll look at that very, very closely as well when we do get that underway. Still with us here on set is Ken Wong, Asia Pacific Portfolio Specialist at Eastspring Investments. Why don't we pick up on the A and H share? Should we call it a rotation, a rebalancing? What's going on in the last, let's call it 3-4 weeks?
Yeah, I think the fact is that when you look at the beginning of the year, H shares were doing very well.
Yep.
There was a very strong push around a lot of the AI, tech-related names within the offshore China stock sectors. But then in the past couple of weeks, and I would say past couple of months actually, we definitely have seen a lot more rotation around A shares. The fact is that a lot of the A share stocks were underperforming relative to the Hong Kong listed shares.
Okay.
As a result, and of course also a strong pickup interest around the domestic investor base in China, that's kind of where we've definitely have seen a lot more strength pushing up, sort of where the CSI 300 level is as compared to where we were even just from a few months ago.
So we're wrapping up the year with clearly the big tech names have done well.
Correct.
Particularly if you're associated with AI. The hardware goes into that bucket. Materials separately, but it's also somewhat an AI play.
Correct.
In terms of the energy and financials. Will those buckets continue to lead performance next year?
Yeah, I mean, right now, if you look at our overall China portfolios right now, we do have a fairly, I would say, a bit more of an overweight position towards some of the financials, especially the non-banking financials. We think, sort of having a bit lower beta to wrap up the year, especially, sort of with the strong year that we've had during, for most of 2025. That's been a very good strategy. In particular, when you look at materials, in addition to the AI play, the fact is that when you talk about energy, we also have to look at CPI. The fact is that CPI has definitely started to pick up, has started trending upwards. That does help material stocks as well. And again, around IT plays, there is definitely still interest around there. But I think looking at better entry points, looking at valuations, and I think more importantly, looking at specifically more policy supports in 2026 is going to be important as well. Because I think over the past couple of months, the markets they've been waiting for more policy support, more stimulus to come from the Chinese government in order to see specifically what sectors will stand to benefit. I think right now that's why investors are quietly waiting on the sidelines to see kind of where things will head towards in 2026 around policies. Yeah,
I think that the point you're making, our producers are just showing this chart, which is the swap spread, I think 5-1, which does show you some reflation is starting to come through in the rates market. Does the macro improve materially next year? Because that seems to still be the sticking point that some people still have question marks over.
I think around consumption is always going to be a very key point. The fact is that when you look at, if we're going to target around that 4.5%, 5% GDP target, if we can get to those levels, it's going to be very important to see kind of where consumption will be at the end of next year. The fact is that overall net exports, that's a bit of a question mark as to, kind of where we're going to be with net exports, because given all the geopolitical tensions, tariffs, and so forth, that's still a big question mark. The fact is that investments, can investments continue to drive economic growth in China, for the foreseeable future? That's not also a viable solution as well long term, right? The fact is that consumption does have to come in. Overall, high-end consumption in China has started to pick up as a result of the stock markets, right? Stock markets.
The wealth effect?
Exactly. The wealth effect has definitely helped specifically more of the higher end good items. But I think more importantly as well into 2026, jobs, wage growth, kind of where those things are going to be for China, I think that's going to be a key driver. If we can continue to see more job growth, if we can see more wage growth, if the stock market continues to be on a similar trajectory as what we've seen this year, it's going to really help, I would say, overall consumption levels, because it seems as though, overall, it's still, I would say, especially around sort of the more consumer staple products and some of the lower end consumer discretionary products, there needs to be a bit of pickup on that. And so we're going to try to see specifically where things will be kind of over the next couple of quarters to see whether or not kind of Chinese economy can kind of have that revival, have that recovery in terms of getting up to that 5%. But more driven by consumption as opposed to net exports or investments.
What's interesting about that point you just made was a theme that's emerged parallel to the softening of the macro data. And I'll just, and we don't have to talk about the name specifically, but say more threads, right? A lot of the onshore specific chip plays have started to list. You saw how good they're doing in the secondary market on the first day. And I wonder whether we're entering a new phase where Chinese mid-caps, future large caps maybe, is the way to play the market in the Asia market. Are you guys looking more closely at how play the AI play there?
No, it's something that we've been looking at. Not necessarily. You're not only looking at the CSI 300, as kind of the stocks that you can invest in. Right. Yeah. Domestically, there's a lot more. Yeah. 5,000 names on the A shares. So those 300 CSI 300 stocks aside, there's still 4,700 stocks within the A-share market. And a lot of those specifically, as you mentioned earlier, even some of the stocks listed in Shenzhen, China. Shenzhen has been the outperformer this year as compared to Shanghai. The fact is that has been partially because of the AI play. So for us, invested within China, that mid and small cap space is also definitely a way to go because even the mid small caps within the domestic China A shares are very liquid. So sometimes the concerns around liquidity, are you able to really get in and out of those positions as needed? That's not really a problem.
Yeah, well, especially for a big player like you guys, where you tend to move the markets. Okay, so we'll have some final thoughts with Ken Wong in a moment. He'll be rejoining us out of Eastspring Investments. Just to mention, and just on that last point we were just talking about there, right? Trading debuts along the AI play. This is one in Hong Kong here. I think we're doing well. Just going to coming up on your screens. There we go. 300% on Nobicon AI Tech. That's one of the names we're tracking here today. Hang Seng Index futures are pointing also slightly to the upside. Last we checked, dollar China has been on the weaker side from the fixing. Still stronger, of course, from the cutoff, and that's an extremely liberal and generous description there. 7 minutes to the opening bell. Plenty more ahead. This is the China Show. Right, welcome back. A check. You have some trading debuts today, some doing better than others. Quite a substantial move either side of zero. We'll check in on these names in a couple of minutes. These tend to have, of course, fairly substantial moves. I should tell you this time yesterday, the debuts that did hit the market yesterday saw substantial losses in the opening minutes and then, of course, started to come off lows towards the end of the session. Okay, so we will table that for now and just have a look at the copper plays on the back of the copper rally, copper in Shanghai. You have the London one, which is, as you can see, we're coming off highs, but 12,000. Right, very much in focus. We're probably a good day away from that milestone. Jiangxi Copper, I think, was up 5% yesterday for the 1.3% right now. Zijin Mining, of course, is both. Let's just call it a material play, right? So you have the gold story. In case you missed that, it's on the headline on one of the Bloomberg stories today. 50 record highs on gold this year, and gold's underperformed silver, I think, by a factor of half. Silver's up 150%, give or take, this year. And going into the open today, 0.3% to the upside. Hang Seng Index, A50 futures slightly flat. We've seen this rotation, of course, back into the A-share markets. And that chart, I'll show you in a moment, on the Chinese Index is coming up after the opening bell. That's coming up next. This is Bloomberg. Right, welcome back. You're watching the China Show. Counting down to the open of trade. Well, a couple of things, right? So if you are fans of moving averages, we're knocking on the door of one specific one on the Shanghai Comp and CSI 300 to the upside, right? So let's see whether or not we do get a substantial and a sustained break above that level. Second point, I think we're also looking at overnight repo rates. If I haven't woken you up already, the fact that actually has traded near a 2-year low. Substantial volumes coming through on that specific one on Friday, hence we're looking at that too. Thank you so much, my producers. And also the other thing we're tracking going into the open today, yes, I forgot. Citi was out with a note just today here, upgrading Taiwan on the AI story, downgrading China to neutral on the macro. So we'll get into that. We're flat at the open. Chinex is one, of course, we're tracking. I'll get you a cool chart in a moment on that specific one. Do we have copper? There we go. We're down about a 1%. Let's have a look at Hong Kong, please, and the opening here. And the Hang Seng Index, Hang Seng Tech did see somewhat of a bounce yesterday. I should note, though, if you squint, the 50, I think it's the 50-day on the Hang Seng is actually close to crossing below the 100, not the 200, so the 100. So that could be a mild bearish warning, but that is just to say momentum in the last few weeks has ebbed, okay, just to borrow some verbiage that we use here a lot. Okay, China Vanke, averting a default, longer grace periods, that's on one bond. We'll talk more about some of the other things in a moment there. A&H shares on your screens, not much market reaction there. We're also looking at this next group of stocks coming up on your screens as well here. And the reason we're looking at that is that the former, well, the top one says it's entered into a strategic deal with the bottom one in terms of these large model AI applications. Somewhat expected of a move there, 2.5% to the upside. Okay, as promised, we're looking at the China index and this rotation rebalancing last few weeks or so. The ratio between the Hang Seng Tech and the China index, the chart goes up, China is outperforming, the chart goes down, Hang Seng Tech is outperforming, and we are nearing the highs that we hit, of course, very, very recently. China has really gained ground on the back of this pivot into mainland Chinese AI plays. And for more on that story, joining us here on sets is Sang-Mi Cha, Asia Equities reporter, to tell us more about this rally taking place. Take it away.
Right, so the CSI 300 index is, after 2 months of losses, is now heading for gains in December, whereas the Chinese stocks listed in Hong Kong are, extending their declines. And what we're seeing here is basically not the whole wide, broad recovery, but it's more of like a handful of listings that are boosting, single-handedly boosting the benchmark, basically. And we're talking about, of course, Meta X, more threads. So we've been talking about this the whole week. But these AI chip makers are just boosting these benchmark right now. And behind that, there is the Beijing support. We're talking about some serious money here. $70 billion Beijing is mulling to actually put in there to bankroll these chip maker industry. And so the fear is just suddenly erased, right? The market sees that and they're like, oh, there's no way these companies are going to run out of money. So the rally just stays there. And we're seeing that not necessarily in just the money part, but we're seeing that in the regulatory action as well. So Beijing is making it easier for these companies to go public, right? So there's really stringent rules for you to go public, right? But they're easing those rules even for companies that are loss-making. And even for approving growth companies when it comes to China, like you mentioned just now, they're making it a lot easier.
Folks, that's the difference between throwing money at a problem and industrial policy. What are specific names we're tracking, and is the rally sustainable? What are you hearing?
Yeah, so after these blockbuster listings, again, as I mentioned, Meta X and more threads, we have Inflame Technology or the Miran that we talked about yesterday. So a bunch of these GPU makers that's coming into market. And it's just, we're seeing that broadening out of these companies within the AI hardware space, basically. It's not just these headline IPOs, but we're talking about Suzhou Technology. It's one of those optical transceiver makers. We're talking about Optolink. So a bunch of other AI hardware that is within the whole supply chain is actually coming into market. And there is that key prioritization when it comes to localization, right? The push for self-sufficiency. And even though big U.S. players like NVIDIA or AMD have the green light from Washington to sell their chips, lesser advanced chips, to China, what Beijing is saying is they're specifically telling their local companies to go and buy the local companies' products. So there's that. Now, whether this rally is really sustainable, although we have those, policy support and so on, we'll have to see. We'll have to look past their earnings and whether they can really deliver. But for now, the downside risk seems quite low.
Okay, Sang-Mi, thank you so much. Sang-Mi Cha, our Asia Equities reporter on What to Watch. It's almost like you're watching this freshman class that suddenly emerged onto campus, and then you're browsing the new names that effectively, folks, you got to get used to in the next few years or so. Right, just to wrap up the year, have a look at global equities and how I think we're up a third year and we're poised for the best since 2019. This is an annual performance of MSCI all-country index. Against the backdrop and performance of the sorts, let's bring in Ken Wong, some final thoughts. He's, of course, Asian equity portfolio specialist at Eastspring Investments. After a year, well, let's call it a 3-year window of this sort of performance, basic question. What do I continue to own and what do I need to rethink?
Yeah, I think that's a very great question. The fact is that when you look at 2026 and how we're currently positioned right now, overall, when we're looking at pockets of opportunities, if you're still really focusing on AI, definitely, Taiwan, Korea, Japan, China, U.S. continues to be the key play. But of course, if we continue to I wouldn't say continue, but if we start to see even more AI fatigueness, and the fact is that let's say overall AI capex is slowing down. We talked about earlier the delta, and the fact is that if people are concerned that the slowdown will continue longer, then it's really going to be some of those markets where there isn't a lot of AI exposure. India is a very good case in point. The fact is that Indian markets have very little AI exposure. And overall, this is one of the main reasons why this year you've seen a fairly big underperformance in the India stock market. But of course, if we do start to see, let's say, the India market picking up again, you're probably starting to see some investors, especially...
Is that a canary in the coal mine when India starts to outperform?
Yeah, there's some of that opportunity. The fact is that some of that flows that's been going into places like South Korea and Taiwan and also partially China, if some of those flows actually gets reallocated back into India, then it's signs that investors might starting to see, hey, you know what? We might need to diversify a little bit away and move into some of the other markets. So India is a very good example. Southeast Asian markets also have very little AI exposure. So I would say that this is how you would position your exposures specifically around kind of AI. And then, of course, in China, I think it's going to be important to see what further policies, what further stimulus we're going to be getting. I think right now, the weakness within the Hong Kong markets are mostly a sign that investors are waiting to see what is going to come next. That's why, for instance, even for ourselves, we've been reducing some beta exposure, just waiting to see where that opportunity is going to be, as we go into 2026.
Let's bring in the macro, which has really helped the tailwinds, right? You have rate cuts, and the Fed has said they've cut 3 times. They're not sure when they'll cut next. We've heard from other major central banks that they're done with the cutting cycle. If not, I think Australia has flagged a potential hike as the next move. If we try and distill the positive impact from monetary policy into next year, what are the investing conditions going to be like without the tailwinds from lower rates?
Yeah, that's going to be difficult. I think everybody's going to continue to watch what the Fed is going to do. If potentially once we get the new Fed chairman, and then ultimately whether or not we still get potentially these 2 or 3 Fed, sort of interest rate cuts next year in 2026. I think then people will still have some belief that, hey, this rally can continue, especially that tailwind can continue because of low interest rates. But the fact is that if we're not getting that, and it's getting a bit more difficult around, let's say, lower, cheaper funding costs, that will be a problem in 2026 potentially. Because the fact is that when you look at overall market valuations across a lot of the major stock markets, valuations are not that cheap relative to its own history. You look at all-time stock index levels, a lot of markets, with the exception of China, India, and a few other Asian markets here, they're close to their all-time highs already. Right? So I think that's what investors have to look out for, especially if that tailwind from monetary policies is going to go away in 2026.
And what's the best leading indicator of that? The dollar the delta in the dollar? Because dollar softness has really helped.
Correct. Dollar softness has definitely helped this year. Now, can we continue to see that in 2026?
Right.
I think for Asian markets or emerging markets, that's going to be important. Right? When you continue to see a weaker U.S. dollar, we have seen historically over the past 2-3 decades that Asian markets, emerging equity markets, always tends to perform well when you do have that weakness in dollar.
Ken, fantastic speaking to you today.
Pleasure.
This year as well. I was going to say have a great rest of the year, but there's 7 days left, 8 days, so have a great next week.
Thank you.
Ken Wong there, Asian equity portfolio specialist, Eastspring Investments. Okay, let's have a look at the Vanke story now, turning to property in China. So the company has secured a last-minute support from creditors to extend the grace period as pertains to the bond there. Reprieve certainly does help to avoid a default, at least for now. That's the operative word. Let's bring in Min Min Lo, our China correspondent, here to take us through the decision and the relief for now and what was agreed on.
So it's got an additional 30-day in grace period. So we'll be revisiting this issue in end January.
Okay.
Yeah. It asked for a deferment of the principal payment by 12 months, but it didn't get the support it needs. It needs 90%, but it got 20% of support from bondholders.
Okay.
So a month later, we'll be revisiting this to see whether it managed to pay off its debt, and if not, it could be in default, and that would trigger a cascade of different things, right? Cross default on other bonds potentially, because you can see on this board that it still has another bond payment due on December 28, 3.7 billion yuan.
Right.
It's also asking bondholders for a deferment on that particular bond as well. And it still has a list of other debt obligations in the next 6 months or so. So, suffice to say that it has a lot of cash flow problems on its hands.
That's interesting because they needed 90% of the vote to get this past the line. They got 20%, but I guess it also depends on who owns the bond and how the ownership of is constructed, if you will, right? So can we take that same formula, is my question, and look at the December 28 bond and try and extrapolate whether or not it will be difficult for them to get the same vote if in fact they are looking at that same formula?
Yeah, I think bondholders will definitely be looking at what's happening to this December 15 bond and how Vanke is dealing with it as a signal for how they would decide on how to deal with Vanke if it fails to pay on the December 28 bond as well. And right now, there are some analysts who are saying that it's better to call a default earlier rather than keep extending the grace period, because Vanke has many, many important creditors. They have Shenzhen Metro, which extended about 30 billion yuan in shareholder loans. It has all the big banks. And while Vanke gets this 30-day grace period and it operates as usual, this is time that these creditors could use to try to, lay claim on some of its best priced assets, because we had seen, for example, Shenzhen Metro already doing that by retroactively asking Vanke to pledge some assets to previously unsecured loans. So then that leaves less and less assets for bondholders to lay claim to.
Well, yeah, I guess a grace period is better than nothing, right? So we'll revisit this in about a month.
Yes, but some analysts are saying it's probably an inevitable thing that they will have to go through a restructuring at some point.
Okay,
it could be a matter of if not, of when, not if.
At least it's not zero or eggs, as they say. Min, thank you so much. Min Lo, our China correspondent there. A brief look at markets before we take a short break. CSI 300 is now flat. Hang Seng is up about 0.1%. Hang Seng Tech is continuing to feel the pressure. We'll look at Kuaishou, I believe, which is one of the drags on the benchmark today. Plenty more ahead. This is Bloomberg. Welcome back. Let's get you guys an update of some stories that we're tracking and we're following at this point. JP Morgan making some moves here. We'll talk about two things. Let's start things off here with this endeavor where the bank is said to be considering offering cryptocurrency trading to its institutional clients. Now, Bloomberg has learned that the bank is assessing what products and services it could offer to expand its footprint in crypto. Now, the move is a sign of how banks have warmed up to digital assets since a crypto-friendly administration took office. Now, JP Morgan Asset Management is launching a private fund designed to maximize after-tax returns by, get this, generating losses. Now, a source says that the tax-smart, disciplined equity long-short strategy takes bullish positions in a basket of stocks while also betting against certain companies. Now, the so-called tax-aware investing is becoming one of the hottest trends in wealth management as clients seek to reduce their tax bills. Speaking of seeking to reduce, we'll pivot now to interest rates. And of course, Fed Governor Stephen Miran says that the central bank risks sparking a recession unless it continues lowering interest rates next year. Now, he told Bloomberg that the data on housing costs was actually impacted by the government shutdown.
It is true that the shelter stuff was somewhat distorted by some of the quirks of recovering from the shutdown. But it's also true that the shelter data were distorted for most of the year because of really long lags with which shelter inflation is calculated. If you look at market rents, they've been running at about a 1% rate for about 2 years now, right? That's not indicative of any price pressures in housing whatsoever, but it takes a really long time for measured shelter inflation to catch up to that just because of various quirks of the statistical measurement process that I got into in my speech last week. So I do think there was maybe some downward bias in last week's print, but at the same time, there's been tons of upward bias in data for the entire year, and it's inappropriate to say, okay, well, we have to adjust for the downward bias, but we're going to accept the upward bias. That itself is a deeply biased position. We've got to be clear-eyed about both.
Well, do you feel like, and yourself included, but do you feel like members of the Fed are cherry-picking what about inflation they like or dislike?
Well, I mean, I think that for the last few months, we've had data come out in accordance with, I think, my view of the world. The inflation data have steadily come in cooler than expectations. The unemployment rate has poked up, potentially above where people thought it was going to go. And so we've had data that should push people into a dovish direction. And I think it's somewhat problematic if you see those data coming out and you don't adjust your policy prescriptions in a dovish direction. What does that say about the reactiveness of policy to the economy? I think it reflects very poorly upon the institution.
At the end of that speech at Columbia, you nodded to the fact that recessions are inevitable. Fed's job is to kind of forestall them as much as they can. Policymakers' jobs are that. I'm very curious, when you look at the labor market in particular, the rise that we've seen in the unemployment rate, that's the kind of rise we've seen customarily before recessions. How do you assess the risk of there being a recession here in the near term when you look at the labor market, for instance?
So I don't see a recession in the near term, in part because we are adjusting our policy rate by lowering it, which is appropriate. My view, as I've described, is that a variety of shocks that hit the economy, including changes to the population growth rate due to changes in the border policy, have pushed what we call the neutral rate down, and that policy needs to adjust downward to reflect that downward shift in neutral. If we don't adjust policy down, then I think that we do run risks of rising recessions. I don't think it's too late to prevent that, and so I think it's important that we keep on adjusting our policy rate down. But at the moment, it's not my base case, in part because I think that we ultimately will end up continuing to adjust interest rates down.
Fed Governor there, Stephen Miran, of course, making the case for lower rates going into next year. If you're one of our Bloomberg clients and you want to rewatch that full interview or others that we might have done, of course, here on shows, some of the other segments and reports, do check it out. TV Go is a function you run. Also become part of the conversation. You know how to reach us, TV Go. There's a box there at the bottom where you can effectively send us any suggestions, tips, comments, suggested questions you wish us to pose to the guest. Check it out, TV Go. This is Bloomberg. Now to some other big stories we're tracking today at this point. President Trump says that a U.S. Navy will build a new Trump-class battleship. Now, he says that they could build as many as 25 ships as part of this so-called Golden Fleet. It's a bid to revive U.S. shipbuilding and compete against China, which makes the majority of the world's ships. Now, America has not built a heavy gun battleship since the 1940s. A senior Russian general has been killed after a bomb exploded in his car in Moscow. Final Sarvarov was in charge of operational training, the department there in the Russian General Staff. Investigators have opened a murder inquiry and are looking into Ukrainian involvement as a potential theory. Now, Cambodia and Thailand have agreed to meet on Wednesday, that's tomorrow, if you're keeping track here, to discuss conditions for a ceasefire. The decision came after foreign ministers from the Southeast Asian nations met in Kuala Lumpur in Malaysia. At least 40 people have been killed and 500,000 displaced since hostilities resumed this month, ending a July truce that halted an earlier round of fighting. Now, the U.S. Federal Communications Commission says it will ban most foreign-made drones and critical components for unmanned aircraft systems. The new rules apply to future imports and sales, not those already in use. Now, the decision comes ahead of a deadline for adding Chinese drone maker DJI Tech to the agency's covered entity list. Yep, massive player, of course, DJI. We should be talking more about that name. I guess we have the opportunity to do that next year. But speaking of that story, Here we go on your screen, some of the names related to that story and the broader sector listed on the mainland. Not so much, not a big movement there. Dairy stocks, I think it was late on Monday, if you are in the Asia Pacific, China introducing some levies as it pertains to dairy imports from the EU. I think there's a fantastic graphic in the story if you want to check that out in terms of where China is as far as its rank in buyers of EU dairy all throughout the world. 2% up to the upside could benefit, of course, some of the local players. That's the initial reaction across these markets. The biggest decliner across the Hang Seng Index, Kuaishou, on your screen shortly. And I think hence we did see, of course, this drag in the underperformance of the Hang Seng Tech Index relative to the other benchmarks on screen. 3.8% as far as that's concerned. Hainan-related stocks also in focus. So we had a big rally yesterday. I think we're seeing an extension of that going into today. And we're looking at 10%, 40%. This is a typical and expected dynamic between the names and what you have as far as policy goes. And, of course, duty-free policy and the optimism there as a tourism hub in Hainan. Right, let's just have a look at how we're doing 25 minutes into the cash market session on a benchmark basis. It's also worth pointing out, at least for 3 or 4 days, we've seen positive, albeit fairly modest, southbound net flows into Hong Kong from the mainland. So the buying does continue, but to the extent, of course, not to the magnitude and same magnitude we've seen in recent months or so. Hang Seng Index, a 10 to 1%. We've been range-bound. We remain range-bound as far as the benchmark goes. Right, speaking of Hong Kong, coming up on the China show, we'll have a closer look at the property sector, commercial, retail, if we have time, maybe residential. CBRE joins us at those times on your screens for their outlook on the property market here in Hong Kong in 2026. We'll have a lot more on the way in the next hour, including, of course, a wrap of the Japanese morning session. You're watching the China show. Welcome back. You're watching the China show, so about a day and a half. Then it's Christmas, so a lot of our viewers, of course, might be joining us from the comforts of their home, at a bar, at a beach. If you're perhaps mulling another cup of that mulled goodness, have another one. Why not? Treat yourself. It's been a good year, hasn't it? For most of you, at least. Thank you for joining us today. We're entering the second hour of the China show. Markets are doing okay. We're up 0.2% on the CSI 300. In fact, comparatively, CSI, well, let's broaden out. A shares versus H shares, onshore versus offshore. We've seen a revival of the former relative to the latter. Is that a rebalancing taking place year end? The fact that the latter has done exceptionally well going into the last month or so. We'll see what happens with that. The play there, of course, has been AI still on both sides of the markets with the Chinex index and, of course, Bell, who I'll bring in a moment, will know a lot more about what's going on, of course, as far as the chip plays and the listings and everything in between. This cornucopia of good news, if you will, around the AI space in mainland China. In fact, let's bring in Bell on that note. She's in Sydney. She'll be our co-anchor and co-pilot for the rest of this hour. Bell, what you watching?
What am I watching? I think I'm watching commodities first, actually, because it's been another strong day for gold, for silver as well. I mean, you're looking at silver, they were very close to that $70 an ounce threshold. Gold futures as well rising to an all-time high. So it's just those continuing geopolitical tensions. You've got those further Fed bets that are having a bearing here, and you're seeing as well reflected in Brent crude prices. But let's also take a look at what's happening in broader markets today too, because you mentioned that optimism around tech, and certainly that has been sort of the key theme that we see across Asian equities. It does seem like maybe we're finally actually getting that Santa Claus rally, just given the trading activity we had in the Wall Street session as well. But those tech-heavy indexes, Taiwan, Kospi, are standing out there. And also, let's just take a look at the Vietnam index, because this is an interesting one. Actually, Vietnam stocks really rallied in the session on Monday, the most since October, but some strong signals there. And our Bloomberg intelligence team is saying that this market is going to be one of the standouts possibly in the Southeast Asian region going into next year. Japan to watch, because this has been a big one, but Japanese bonds are actually pulling a little bit back from their multi-year highs. So, for instance, we've seen the 10-year GJB at the high since 1999. That was in the Monday session. But as well, this speculation that we're going to be seeing the BOJ needing to raise rates more aggressively, certainly been that trading dynamic. Whether, of course, they do that or not is certainly another question. But the Japanese yen also, you can see there, just really holding around those levels, given you've had that jawboning from government officials too. On that point, we had an exclusive interview, as we've been playing this morning, but an exclusive interview with the Japanese finance minister. Let's take a listen.
The yen's sharp, very short-term movement right as the BOJ governor began his press conference last Friday. That was clearly not in line with fundamentals, but rather speculative. Against such moves, we have made clear that we will take bold action, as stated in the Japan-U.S. finance minister's joint statement. We have an agreement with the United States that allows us to intervene whenever the yen makes an excessive move. That means we have a free hand.
Okay, I guess let's call it the strongest warning yet to speculators of maybe a currency, to the point the finance minister was making, that's probably danced a little bit too far from the fundamental confines of the fundamental dance floor. Stephen Chu is with us here on set, our Bloomberg Intelligence Chief Asia FX and Rate Strategist. We saw, nice to see you by the way, dollar yen moved not a lot, but it was a noticeable move down overnight into today. Does it continue, you think, this move?
It depends on the broad dollar move. I think what's interesting regarding the BOJ over the last 2 years is before 2024, 2023, usually they will counter the dollar rise when they intervene. But the latest interventions now, they're actually doing it the other way. They wait for the dollar to drop broadly, and then they intervene. So usually that impact would be bigger to help the yen. But of course, now we have to see that happening. I know markets waiting for more Fed cuts, but the dollar in general is still holding up, especially against Asian currencies. It's still pretty strong. So maybe despite the stronger tone, they want to wait for a little bit longer to wait for that broad dollar sell-off, and then they may have to hit the market.
And what does that look like, Stephen, exactly, hitting the market?
Yeah, I mean, like, if you ask me, certainly it's a little bit too cheap, the yen. Our model, if you just look at rate differential or other fundamental matter, dollar yen should be around 130, 135 right now. But actually, we are closer to 160, the level that we saw like 2 years ago. After some Fed cuts, after some BOJ hikes and more to come next year, it's certainly too cheap, the yen. So I'm sure they're waiting on the sidelines. They're just waiting for the best moment to hit. So if you ask me, I think at least towards 150 and below should be a reasonable guess if they come into the market.
Yeah, I was going to ask you actually, how do you assess the, when they start intervening, the process isn't direct intervention in the markets, right? It's they drop a hint here or there, they take out stronger language every now and then. Where do you think we are in that process? I think we are
very close, because usually, if I remember correctly, the last warning would be like they're checking the market rates.
Oh, it's about to happen when they do that.
And then it's about to happen like a day or two after that. So we're waiting for that final warning this time as well.
Okay, can I ask you about the Chinese currency?
Of course.
That's been moving from 706, 703. I mean, it's about a week left before the end of the year. Do we see 7 at some point?
It's very clear that China is trying to hold back from that. They're trying to stop market from betting the yuan to break 7. But it's inevitable. And we know that in the first quarter, usually the yuan will strengthen, seasonal factors. So it's just a matter of time, whether it's 2025 or it's 2026, it's going to challenge 7 in time.
Best currency play next year in 2026? Anything under your mandate?
Yuan and the ringgit.
That's long?
Yeah.
Long on both?
Yeah. Regardless of the dollar move, both of them fundamentally strong.
Why the ringgit? Just quickly on
it's
that.
similar to China. It's actually because of the trade surplus and the FDI flows. And also, if a strong Chinese yuan will also favor a strong ringgit as well.
Fantastic. Thank you so much. Stephen Chu there with really just a recap of the yen, the yuan, and his topics, including the yuan and the ringgit. Our Bloomberg Intelligence Chief Asia FX and Rate Strategist there. Right. Coming up here on shows, we'll have a closer look, a deeper dive into the Hong Kong property market. So not just residential, although if we have time, we'll get into that, of course. Things like offices, for example. We've seen some big deals being signed. We have some grade A office space coming online in the next few years here in Hong Kong. So will there be enough take-up as far as demand is concerned? Who are the big players coming to the market right now? Where's demand coming from? CBRE joins us in a couple of minutes for that conversation. Amid signs that the market Question mark. Has bottomed out? That's next. This is the China Show. Welcome back. You're watching the China Show. We're looking at A and H shares. If you go from top to bottom there. China Vanke averting a default for now. I think this is one specific bond. We'll get to the other bonds in a moment here, but it has secured this last-minute deal and what that deal in support looks like with creditors. Joining us here in set to talk us through the progress that a company's made. Min Lo, our China correspondent, is here with us on set on what's next now for the company.
So the company now has secured this 30-day extension to its grace period. So within the 30 days, it has to pay up its principal and interest on the bond that was expired on December 15. Okay. If not, then bondholders can call default, unless within that time frame, they are able to come to an agreement with bondholders. But again, they have already had several meetings with bondholders. They have put out a few proposals asking for deferment of the principal payment by 12 months. The first proposal was really, really bad. There was no upfront payment, no installments. The second proposal had some credit enhancement and yet still didn't pass the bondholders' support, right? They needed 90% support. They only got 20%. And here on this board, you can see they have another bond due on December 28, 3.7 billion yuan. They're also asking for deferment of payment on that particular bond as well. So the next few weeks will be a really crucial test for Vanke, because if it defaults, that could trigger a cascading effect and cross default on other bonds as well, including for offshore bondholders.
Can we take it that might be the same formula we'll see with the upcoming one on the 28th? Because that's one's also been in question, right?
Yeah, so that could be the same formula, and we will have to see. So the next month is really a crucial window. But you have these onshore bondholders. They have I believe about 13 billion yuan worth of debt due by the next 6 months. And they have $1.3 billion worth of offshore debt as well that they have to pay. And the offshore bondholders, I mean, it's being held by important banks like UBS, Fidelity, HSBC. I believe Fidelity is one of those that told us they have already diluted their holdings. Their holdings are negligible now. The others haven't responded to our request for comments. But it's going to be quite critical, because if they default on the onshore bonds, it would trigger the cross-default clause. And the offshore bondholders basically are the least advantageous given the structural subordination, which means that they can only lay claim to assets owned by Vanke's offshore unit, the Hong Kong unit, which only owns very little asset, basically one logistics company that's worth about $2 billion in book value. So on average, analysts are saying that offshore bondholders could recover maybe about 20% of the value of their bonds. Okay, at least it's not zero. Min, thank you so much. Min Lo, our China correspondent there. Let me borrow your paper because I need some notes here. Thank you so much. Okay, let's turn our attention to Hong Kong now. The reason I need my notes is a lot of numbers are coming up on your screens here, right? So we're looking at let's call it the office glut, but the big deals that are starting to come in to fill the office space. You have global multi-strategy hedge fund firm, of course, as you can see in yellow there. A deal that was just signed, of course, to IFC, quite a big one there. Second largest prime office lease in Hong Kong Central Business District in more than 10 years. Now, it joins a lot of deep-pocketed financial firms, and as you can see, the dates of signing across the last, let's call it 15 years or so, the names and where they have, of course, housed their operations. Now, that does bring to mind this glut of new supply that's coming to market, plus you have the cost-cutting firms at other companies that have pushed up the vacancy rates across prime office space and depressed, up until maybe recently, rental rates. Does that change? Have we hit a bottom? Are there signs of a strong bottom? And what is the outlook going into 2026? Joining us here on set is the head of Valuation and Advisory Services at CBRE Hong Kong, Jeong. Good morning. Very nice to see you. So has the office market bottomed out?
I think Hong Kong has seen a really interesting market dynamic 2025.
Okay.
It's hard to say bottom down because Hong Kong, we still have multiple supplies coming up in the next 10 years, especially for the office market.
Yeah.
But we do see activities picking up, especially the leasing. The one you mentioned, IFC. So there was a UBS moving out from IFC in the future to the XRA station, which is now Global Gateway. That space has been all filled up or waiting list. So technically IFC has only 2% of a vacancy. That shows market is really active. But we do see still negative growth of a rental. 70% of a vacancy concentration are the buildings offering below $40 Hong Kong per square foot rental. So those are second tier location, not necessary to be in central. They are underperforming, but IFC or central itself, they are outperforming against market. So we do see rental growth turning positive in 2026. But overall, we are still looking at the negative growth of office market.
So grade A office space, let's just maybe specify the actual category. What's the current occupancy rate generally?
So vacancy is around 17%.
Currently?
Currently, yes,
Okay.
yes.
And the expectation is that goes
For
down?
next year, we are going up further.
Oh, because we have new stuff coming online?
Yes, correct, yes.
Okay, talk to us about, we talked about some of the big deals recently. Where has the recent demand emerged from? Who are the sort of the big groups that are coming into the city and taking up more space?
So a lot of activities now happening is really the existing tenant relocating to better quality buildings or consolidating different location into one office.
Okay.
So that's the activity we have seen. The Henderson, the brand new signature building in Hong Kong.
Yeah, they blocked our view.
Shower.
Yeah, across the
So
street.
that is almost 85% occupied. So that shows a really good take up in terms of people looking for the better quality buildings. So that's one action. But we do see IPO impact going forward. So we have over 100 IPOs happen in 2025. And that's the largest number compared to New York and any other cities, right? So if they come to Hong Kong, now maybe they have a satellite city, offices, small, like less than 5 people, but once the market goes up and their business grow, then they will expand the space within Hong Kong. So that's one thing we have to pay attention. And then government pushing so much effort on the wealth management, private equity fund, hub, arbitration centers. So those newcomers are expecting coming up for 2026 or beyond, but scale will be quite smaller than what we expected. Yeah.
A lot of these IPOs, of course, are Chinese companies that are looking to do listings in Hong Kong. Is this where the demand is really coming from? Mainland companies looking to set up space in the city?
I think there are two major demands. One is, yes, mainland occupiers. They're looking for setting up the new offices in Hong Kong. But again, the scale may be smaller in the beginning, like less than 2,000 square feet. And second part is really they're looking at the long-term investment in Hong Kong. So we have seen major deals happening. For example, JD.com, they spent $3.5 billion Hong Kong to buying 50% of a CCB tower in Central. And then Alibaba, they also announced that they bought, they signed a deal of 13 stories of One Causeway Bay, the newly built building by Mandarin Hotel. So that's over $7 billion. So those occupiers, they look for the house which can be very long term. They will buy at this moment because it's almost a bottom fishing market. So we do see two active market. One is coming to Hong Kong as a new setup and looking for the smaller office as a beginning. But at the same time, those giant tech companies or mainland bigger companies are looking for buying bigger assets in Hong Kong for the long-term investment as well.
What about the prices? Even if there's demand that you're seeing, especially more in the premium segment, are the prices that companies are willing to pay the same as what we saw, say, going back, I guess, to 2019?
Definitely no. So I think the reason they are buying at this moment is a really good price, right? It's a good bargain. So that make them make a good decision right now. So for example, if CCB Tower, JD.com bought at 29,000 per square foot Hong Kong dollar, if you compare the Henderson, the one we just mentioned, the flower-shaped building as a new landmark, the land price is there was 55,000. So you buy already built product, grade A office building within Central, almost a half price of what land price used to be. So I think at this moment, the price level is really reasonable. And if people are looking for the long-term investment, maybe this is the right timing. Therefore, they are looking at the deals right now.
So you mentioned, okay, so there's the premium segment and then there's this second tier segment, and you're saying that there's a lot more vacancies in this area. What happens for that category, do you think, in 2026?
They still need to go through adjustment in terms of a rent. So $40 below buildings will have a significant competition in the market. So some of the rumor we are saying, some area, if you grade A office building, you can still enter below $20. So the competition is quite severe. But again, once the occupancy come to stabilize, I think that we will see that the market will be stabilized. 19% or 17% vacancy sounds really big, but if you compare with the other peer cities like China, 4 main first-tier cities, they are looking at over 25%. So we are not that bad off. And also, if we stabilize, we may ending up close to 10%. I think that's a reasonable adjustment. Given the long-term historical in Hong Kong, our vacancy was always below 5%. That was not healthy. A lot of companies, they can't expand. They can't enter the Hong Kong because of such a high occupation cost. But once we reach at the stabilize of 10%, I think that will actually help the market, Hong Kong as a more attractive place to bring business back to Hong Kong as well.
You know, that's a good point. And by the way, separately, and if you want to comment on it, feel free to do so. I think we're just getting a line coming through here. The Cheng family is seeking to sell the London Rosewood Hotel, and certainly there have been conversations around the Rosewood, generally speaking, what assets. Asset light, of course, is how much you actually get from that. Separately on that too, right? So K11 Skies, which if you've landed into Hong Kong Airport or taking off, it's at Massive Mall. But I believe it's Terminal 1, Terminal 2, it's at Massive Mall, which is largely empty. So conversations around what happens with retail space. But yes, that's what we're hearing so far, and we will get more information to you once we get more details on the story. But Hannah, let me just bring you back on just one question on offices, and we can move on to other parts of the market. So people talk about this K-shaped recovery globally. So you have the big multinational conglomerates, and then you have effectively a suffering middle and lower segments. And you mentioned sort of the second-tier office market. People are upgrading into better spaces, better locations. Do you see demand in terms of that middle segment for offices in Hong Kong?
I think most of companies still looking for cost savings. So yes, we do have a demand there.
Okay.
So if a grade A office building, lower rental because of a location whatsoever, yes, they have to go through this transitional period. But the building is really getting old, some clusters, right? And they may not call it grade A. So government announced that, okay, grade B, grade C buildings, now you can convert to student hostels because we are increasing foreign students from 20% to 40% quota per all the universities. Okay. So we will have a more student coming up. Can you guys convert the existing building, which is non-performing, into something else? And then that policy came out this year, and we do see a number of activities on that angle as well.
Well,
Hannah, we really can't let you go without asking for the many renters in the Hong Kong market, myself included, what is the outlook for rental prices next year?
So we do still see rental downside for 2026, but it will be marginally stabilized. So we are looking at about minus 30% in overall. But Central, though, we are looking at possible growth like 0 to 3%. Because it's so tight vacancy within the top performing buildings, technically you can't enter anymore. So landlords are positioning, like especially Hong Kong Land, they announced that, okay, no more rental concession as much as what we offer before, or Cheong Kong, etc. They're all looking at the increase of asking rent. So we will see quite different dynamic between Central versus to other districts.
Okay. Hannah, thank you so much. Very nice to see you. Happy New Year.
Happy New Year.
Hannah Jeong, their head of valuation and advisory services at CBRE in Hong Kong. Right, just ahead here on the China Show, we're talking about Huawei. They're pulling ahead, get this, in China's luxury car race. We'll take a closer look at this cool sedan and its auto plants, broader auto plants later on the show. Plenty more ahead. This is The China Show.
Welcome back. Well, here are some of the major stories we're following. Cambodia and Thailand have agreed to meet on Wednesday to discuss conditions for a ceasefire. The decision came after foreign ministers from Southeast Asian nations met in Kuala Lumpur. At least 40 people have been killed and 500,000 displaced since hostilities resumed this month, ending a July truce that halted an earlier round of fighting. President Trump says the U.S. Navy will build a new Trump-class battleship. He says they could build as many as 25 ships as part of the so-called Golden Fleet. It's a bid to revive U.S. shipbuilding and compete against China, which makes the majority of the world's ships. America has not built a heavy gun battleship since the 1940s. And taking a look at one of the big movers in the space of this, Hanwha Ocean is surging in Seoul today because during that press conference, Trump did announce that Hanwha Group or Hanwha Ocean would be involved in this effort. It is a company as well that's pledged to increase its investments in the US to the tune of around $5 billion as part of a bigger commitment that South Korea is making to shipbuilding in the States. More ahead. This is Bloomberg.
Right, it's just about a minute away from the lunch break over in Tokyo. Equity markets specifically are looking like this, a 10 to 1% to the upside. That's on the Nikkei 225. At about these levels, in case you were living under a rock for like 3 or 4 years, we're up about 200% from, I think it was the bottom back in 2020. Suffice to say, it's done very, very well on price. Topics index is also doing well. The banks, of course, on the back of the rate hike conversations, 1.2%, although we're going the opposite way as far as the JGB yield curve is concerned. We have seen successive days, of course, of yields melting up. It's the opposite. Curve is coming up on your screens. We're down just about across the curve from the twos all the way to the longer end of the curve. A lot of conversations around the Japanese currency. It had a big move down, of course. Stronger on the Japanese currency. Yen crosses on your screens. And really goes to show how close we are. That's still an open question to direct intervention in this market. When you look at how markets have been positioning around the Japanese currency, coming up very shortly on your screens, net bearish outstanding positions on the Japanese currency, leveraged funds only. So you have speculators, not so much asset managers and actual users of the actual currency. But as you can see, markets are not just net bearish on the currency, right? The biggest bearish position going back to mid-2024. That's as of about 2 weeks ago, based on the latest conversations and data. So why is this important, right? So markets have been speculating for a weakened currency. You're getting pushback now from officials. In fact, the finance minister has issued her strongest warning yet to speculators, telling Bloomberg that officials have a free hand to take action. Tatsuki Katayama spoke to us exclusively over in Tokyo.
為替の状況っていうのは必ずしも
Foreign exchange markets don't move only on interest rates or rate differentials. Especially toward the end of the year, around Christmas, trading tends to get thin, and many factors can drive the yen's moves. But the yen's sharp, very short-term movement right as the BOJ governor began his press conference last Friday, that was clearly not in line with fundamentals, but rather speculative. Against such moves, we have made clear that we will take bold action, as stated in the Japan-U.S. finance minister's joint statement.
Now that the Bank of Japan has moved to raise interest rates, the next focus is clearly on whether the government will step in with foreign exchange intervention. How do you see it?
We have
an agreement with the United States that allows us to intervene whenever the yen makes an excessive move. That means we have a free hand.
In the past, a finance official has called a 10-yen move in a little more than a month excessive. So what kind of time frame and magnitude would you consider a sharp or disorderly move? Is there any benchmark you use to assess that?
I can't say definitively whether there's a benchmark or not. I worked closely with currency chiefs during my 20 years at the finance ministry, and I've stayed in close touch with many of those who came after I left. Each situation is different, so it would be wrong to expect the same pattern every time.
Trading tends to thin out around the year-end and New Year period. Is it fair to say that the authorities are fully prepared to respond?
We're always ready to act. That goes without saying.
When it comes to a question of a certain degree of fiscal discipline, there are various ways to interpret that. For example, how much the government relies on bond issuance or how much JGBs it'll issue. Could you share a bit more on how you're thinking about these points?
I
can't give you specific numbers, but even after the supplementary budget was passed, we made it clear that the total amount of government bond issuance, which, after all, is what puts pressure on the market, did not increase. At this time, we're talking about the initial budget for fiscal year 2026. We're confident that it won't be something that places an undue burden on the market either.
There are concerns in the market that Japan's fiscal position may be deteriorating. What message would you like to send in response to those concerns?
By switching to active fiscal policy, we knew before we started that in the first fiscal year, some of the finance numbers would deteriorate. But that isn't the problem. We've spent 10, 20, even 30 years in a situation where economic growth barely picked up no matter what we did. There's no point in just doing the same things as before. We need to make a decisive shift, to concentrate resources and boost our growth potential. I believe we'll see a strong pickup in investment next year. And if you look at projected tax revenues for next year and the year after, I think what looks like fiscal deterioration now will prove to be only temporary.
That was the Japanese Finance Minister Satsuki Katayama speaking exclusively with Bloomberg's Takashi Umekawa in Tokyo. And coming up, we'll have a look at New Zealand because it's standing to gain, or what it stands to gain from its newly signed free trade deal with India. Its Trade Minister Todd McClay joins us on Inside with Haslinda Amin. That's at the top of the next hour. This is Bloomberg. Here are some of the stories we're tracking today. And Alphabet shares closed higher. That's after the company says it's buying clean energy developer Intersect Power for $4.75 billion in cash, plus existing debt. The move will allow Alphabet to expand its AI data center footprint. Aging US grids are struggling to meet power demand that's booming for the first time in decades, thanks in part to artificial intelligence. We're keeping an eye on WingTech shares. That's after its chairwoman warned that global chip supplies remain at risk unless the company's control over Dutch chipmaker Nexperia is restored. Ruby Young has accused the Dutch government of breaching a bilateral investment treaty with China. The dispute is raising questions about the supply of components critical to the automotive and consumer electronics industries.
Let's stay somewhat on AI and talk about the funding part of the conversation here. You have Bank of America CEO Brian Moynihan talking about the U.S. economy will be strong going into 2026. A lot of that is due in part to companies ramping up, speaking of AI, their AI investments. He spoke to Bloomberg about the new technologies growing economic benefits and how we should maybe be prepared to see the economic fruits of that exercise.
The AI investment's been building during the year and is probably a bigger contributor next year and the years beyond. And so if you look at the data center build out, which is one of the ways it evidences itself, that's a big deal. If you look at customer or client spending, like us spending on AI, that's higher than it was last year. But frankly, overall spending levels are shifting towards that, not necessarily growing at a mid-single digit rate type of number. So I think that's part why the reason we feel constructive for next year. We think AI spending continues. We think there's benefits to the American taxpayer from tax rebates, lower taxes due to the tax bill going through and being effective for next year. And we think the expensing and other bonuses for businesses are good. So all that leads to our confidence that we go from basically a 2% type of growth level this year plus or minus up to 2.4%, which is all due to that. And AI is kicking in more and more. And so it's not all attributable to AI, but that's having a marginal impact that's pretty strong.
So much of the American economy is supported by the consumer, and you at Bank of America have a really powerful viewpoint into the American consumer. How's the American consumer doing? Because it has been very strong. There have been some people saying it's starting to slow down.
You have to step back. We look at American consumers, 70 million consumers, putting $4.5 trillion plus into the American economy every year. And we've tracked the way that goes in the American economy for many years. And so in the third quarter, it was up about 5% over last year. As we look at the fourth quarter here so far in October, November, I'd say it in a 4.5%, which is very consistent with a very solid growing economy. In the end of the day, it's going to work against wage growth. And we see in the underlying consumers we have wage growth, i.e. their paychecks are going up. And so the labor market's flattened out a little bit in terms of job growth and things like that. It's normalizing in terms of unemployment, but you still see underlying wage growth. So the American consumer spending at 4% more November this year versus November last year is a very solid backdrop. The credit quality of the American consumer is strong. And then you hear a lot about this discussion about different rates of growth among different income terciles or thirds. So if we look at the bottom third, middle third, and top third American income people in the Bank of America customer base, we do see differences, i.e. the higher income and middle income are growing faster. But even the lower income third is still growing, and that's all good. And that means, why is that true? Companies are employing people, they're paying people. Now the labor market's got a little soft, and as we look forward at 4.5, 4.6 unemployment, that is gotten worse, so to speak, than it was at the beginning of the year. But frankly, this goes back to the normalization question. If you look at the 10-year average unemployment, the 20-year, the 30-year, 40-year, it's 5% and 6%, as you go back through time. And so a 4.5 to 4.6 unemployment rate is a very strong relative unemployment rate. It's just a lot of the years it's been below 4.5% has actually been in the last 10 years. So people are very used to numbers now, which were part of the tightness in labor in the 2017, 18, 19 era. Then you had the pandemic and it retightened. And so it's normalizing, but we feel good about all that, and the consumer's in pretty good shape.
That was the Bank of America CEO Brian Moynihan on Bloomberg's Wall Street Week with David Weston. And if you're a subscriber and you want to re-watch that interview, you definitely can via our interactive function, that's TV Go. You can also become part of the conversation by sending us instant messages, so do check it out at TV Go. This is Bloomberg.
Right, welcome back. Let's talk about cars. So you're looking at the ultra-luxury sedan out of Huawei, and I guess in terms of just relevance, right, it's become the top-selling car above $100,000 in China. It's beating out brands like Porsche, Mercedes-Benz. It's billed as a rival to a Rolls-Royce or even a Bentley, and it comes with features such as auto parking, crystal buttons, if ever you think you needed to complete your life with something like that. Joining us here in set to talk about the car, the prospects, what people are saying about this, and could this actually have a longer road ahead, no pun intended, or pun intended. Linda Liu is here with us, our Asia transport reporter. Can I just ask you to begin with, how do you pronounce the name of this sedan? So I can say S800, but how do you pronounce the other one?
Yes, so I think it's pronounced Huawei Maestro.
Maestro, okay.
Which is a play on the word maestro.
Yes,
Italian.
with an X.
Yes, with an X.
Yeah, okay.
Yes.
Okay, how much does it go for?
So it starts from 700,000 yuan in China.
Okay.
Yep.
And clearly it's doing well. Talk to us about demand.
It's doing very well. I think not a lot of people expected it to kind of run out of the gate. It was only launched half a year ago, and now is already outselling the Porsche Panamera as well as the BMW 7 Series. Essentially, it's topped the sales chart for luxury sedans that's priced at $100,000 and above. And that's something that no other Chinese brand has done before. For mass market brands like BYD and Tesla, you see them really driving this transition to EVs. But the luxury segment was where the legacy brands still had a lot of power.
Yeah, okay, so we're looking at, we mentioned that Rolls-Royce, Porsche, even the Maybach, for example, it's still quite a bit in terms of the price, though, from the... so how is this being marketed as an ultra-luxury car? And talk to us about the target market of this car, because you go from a Panamera to this specific sedan to a Maybach. Those are almost completely different sets of buyers, if you will.
Yeah, that is true. Yeah. I would say the Panamera may be a little bit more sporty, whereas the right. Maybach is more for business executives.
Okay.
So I think the Maestro probably targets itself to similar market segment as the Maybach. So business executives in China, and especially people who are wanting to try new things, but still enjoy those touches of luxury. So you get the top of the line Huawei technology in this car, the most advanced driving assistance technology. You have auto parking. The doors will open themselves, and the windows will tint when you just wave your hands inside. So this really kind of futuristic technology that's been added to a car that still has a lot of the conventional premium touches you still would see in a Rolls-Royce.
Yeah, and there's also a door handle. Anyway, triple screen dashboard, 40-inch movie projector, crystal buttons, 30 sensors that the doors that open automatically. And this was a car that was launched just a few months ago, and from a company that previously was not known to make cars. Talk to us about Huawei, and it's sort of the new contender in this space here.
Yeah, so the car was launched in May, and Huawei produced this car with its manufacturing partner, JAC Group, which actually previously was probably more known for its trucks. So really seeing Huawei transforming these Chinese automakers that were previously probably more known for producing affordable models or commercial vehicles. And now Huawei's brand cachet, being associated with a domestic champion, has really lifted these products into these luxury segments. And that's something that Huawei has done really well. You have BYD also trying to crack this market with its Yangwang series that's priced around 1 million yuan. But BYD hasn't been able to sell as many of its Yangwang vehicles as the Huawei has done with its Aito and Maestro brands.
Okay, well, something to mull for Christmas, not for me. Okay, just because I don't have the money for this. Thank you so much, Linda Liu there, our Asia transport reporter. I actually haven't owned a car in a very long time. That's just don't need to, right? I like to walk. Right? Get your steps in. What are we doing now? 15,000 steps. Okay. And it's only 10:47. And I've been sitting for 2 hours. Anyway, an automaker is also in focus in today's Big Take. It details the development of Tesla's electric doors and how engineers, speaking of what we just maybe alluded to just now here, had previously raised safety concerns about them. You can read about it now on the terminal. It's also via the function. It's on the terminal. It's via NI Big Take. It's also on the website and also on Bloomberg.com. Belle.
Yeah, Dave, definitely an investigation that's been ongoing here at Bloomberg. But let's also take a look at some of the other stories we're tracking today, because Novo Nordisk has been a big one, jumping in late trade after it secured FDA approval for a pill version of its weight loss shot, Wegovy. The pill's expected to launch in the US in early January, and the product is crucial for Novo's strategy to take on Eli Lilly, which has said its own oral obesity drug could be approved by March. JP Morgan is said to be considering offering cryptocurrency trading to its institutional clients. Bloomberg's learned the bank is assessing what products and services it could offer to expand its footprint in crypto. The move is a sign of how banks have warmed up to digital assets since a crypto-friendly administration took office. JP Morgan Asset Management is launching a private fund designed to maximize after-tax returns by generating losses. A source says the tax-smart, disciplined equity long-short strategy takes bullish positions in a basket of stocks while also betting against certain companies. So-called tax-aware investment is becoming one of the hottest trends in wealth management as clients seek to reduce their tax bills. Dave, maybe you should look into that if you're trying to save up for a car then.
Well, if you have no income, you have no tax, right? There. So I think that's a problem I don't have to worry about.
Solves that one
for you. Well, speaking of reduces, right? I didn't even do it deliberately. I guess it's a life choice, isn't it? Speaking of reducing things, let's talk about the Fed and interest rates. So we've had 3 cuts. You had Fed Governor Stephen Miran obviously on the dovish side of things. Talking about a central bank risks sparking a recession, a U.S. recession, unless it continues lowering interest rates going into 2026. He also told Bloomberg that the data on housing costs was actually impacted by the government shutdown.
It is true that the shelter stuff was somewhat distorted by some of the quirks of recovering from the shutdown. But it's also true that the shelter data were distorted for most of the year because of really long lags with which shelter inflation is calculated. If you look at market rents, they've been running at about a 1% rate for about 2 years now, right? That's not indicative of any price pressures in housing whatsoever, but it takes a really long time for measured shelter inflation to catch up to that just because of various quirks of the statistical measurement process that I got into in my speech last week. So I do think there was maybe some downward bias in last week's print, but at the same time, there's been tons of upward bias in data for the entire year, and it's inappropriate to say, okay, well, we have to adjust for the downward bias, but we're going to accept the upward bias. That itself is a deeply biased position. We've got to be clear-eyed about both.
Well, do you feel like, and yourself included, but do you feel like members of the Fed are cherry-picking what about inflation they like or dislike?
Well, I mean, I think that for the last few months, we've had data come out in accordance with, I think, my view of the world. The inflation data have steadily come in cooler than expectations. The unemployment rate has poked up, potentially above where people thought it was going to go. And so we've had data that should push people into a dovish direction. And I think it's somewhat problematic if you see those data coming out and you don't adjust your policy prescriptions in a dovish direction. What does that say about the reactiveness of policy to the economy? I think it reflects very poorly upon the institution.
At the end of that speech at Columbia, you nodded to the fact that recessions are inevitable. Fed's job is to kind of forestall them as much as they can. Policymakers' jobs are that. I'm very curious, when you look at the labor market in particular, the rise that we've seen in the unemployment rate, that's kind of rise we've seen customarily before recessions. How do you assess the risk of there being a recession here in the near term when you look at the labor market, for instance? So I don't see a recession in the near term, in part because we are adjusting our policy rate by lowering it, which is appropriate. My view, as I've described, is that a variety of shocks that hit the economy, including changes to the population growth rate due to changes in the border policy, have pushed what we call the neutral rate down, and that policy needs to adjust downward to reflect that downward shift in neutral. If we don't adjust policy down, then I think that we do run risks of rising recessions. I don't think it's too late to prevent that, and so I think it's important that we keep on adjusting our policy rate down. But at the moment, it's not my base case, in part because I think that we ultimately will end up continuing to adjust interest rates down.
Right. The latest there on the Fed conversation from with Stephen Miran, of course, Fed governor, and with the colleagues in the U.S. Okay, just before we wrap up the show today, just look at some of the movers. We're tracking specific names. The Kuaishou is really to the downside. Last we checked was one of the, if not the biggest points. Drags on the benchmark itself on a percentage basis. Certainly it's coming up on your screens. You do understand why it is one of the bigger losers as far as that is concerned. There was a hack, shortened details. It disclosed some cybersecurity issues to the police. That's probably what's pushing the move to the downside. Xiaomi separately, and this might or may not, so I'm just dying this list, may or may not have to do with the price move, but the company says, according to a spokesperson, that it has no ties with the Chinese military. Of course, if you recall a few days back, one of the stories, of course, is the Pentagon list, annual one, and any Chinese firms that might have ties with the Chinese military. The companies come out and said, nope, no ties with the military. The other big story we're tracking, in fact, just in the last few minutes, is on New World and the continuing conversation specifically around the Rosewood brand. And we understand that, based on our sourcing, is that the London Rosewood Hotel specifically is up for sale. We're flat on the stock itself. Belle.
Yeah, this has been, well, it's one of the 58 Rosewood properties worldwide, but certainly would be a really big flagship for them. That's located in the Holborn district in London. But also just taking a look broader markets today, it's relatively quiet across the board, but we are seeing the Hong Kong session here in focus, given that we are, again, pretty flat. But let's take a look at the broader gauge as well, the MSCI Asia Pacific Index, because we have seen some optimism and this expectation that Santa Claus rally still looks to be intact as we head through the week ahead, of course, holiday trading. But more ahead, this is Bloomberg.